Okay, good morning once again. Today we're going to continue our discussion on financial statements and financial ratio analysis. So here we have the financial statements of, I'm sorry, I wasn't able, let's give this a name. I think this is microdrive. Okay, the financial statements of microdrive for 2021 from 1919 up to 2021. So let's start to learn how to conduct a vertical, okay, and a horizontal analysis. Okay, so we have here, let me just copy the format for this. Vertical analysis and horizontal analysis. So as far as the vertical analysis is concerned, it's also called common size statement. You express all the accounts in terms of a common account. So for the income statement, everything is expressed as a percentage of sales. Okay, so I want you now to create one formula here. Okay, one formula here, and then you can copy everything below. Okay, so all the accounts are expressed in terms of sales. I'll give you a few seconds to do that and kindly share the formula that the Excel formula in this cell so that I can copy it to the right, and then down. Okay, that's what we want. Everything is expressed or divided or proportioned to sales. So for example, sales divided by sales. And then if I go down here, it should be cost of goods sold over sales. Going down here, it should be other expenses over sales. Okay, so what should be the Excel formula here? I'm going to give you a few seconds. Let me pause share for a while, pause recording. Please remind me. So we would want to generate here a formula so that if we copy this to the right, then everything will be expressed in terms of sales. Okay, so we have one answer coming from Patricia and another coming from Gerard. Okay, they're actually the same in this, may times 100 lang kay Patricia. Okay, so let me copy one formula. Okay, so same answer for Gerard and Patricia, Control C. I'll just copy the formula from Gerard. So the suggestion of Gerard is this one. So it's equal to C4 divided by C$4, okay? All right, so everything is expressed in terms of percentage here, all right? And then what happens if I copy this? If I copy this down, so this is, yeah, that's correct. 5.8 divided by 7 million. And so copying it down gives us the correct answer, okay? So everything is expressed in terms of sales. However, when I copy this to the right, okay, what happened? So you now have the sales of 2020 divided by the sales of 2021, okay, which is not the correct one. This should be 100% also, this should be 100%. Because for 2020, all the figures should be benchmark or divided by the sales of 2020. Also, here, this is also not right anymore because your sales of 2019 is being divided by the sales of 2021. It should be, for 2019, everything should be divided by the sales of 2019. So how are we going to, so the answer is partly correct. How are we going to correct the formula? How are we going to improve the formula? Class, how do we improve this formula? So that instead of the sales for 2021, it should be the sales of 2020 if you're in 2020. And then it should be the sales of 2019 if you're in 2019. So everything should be divided by the sales of that specific period. Okay, so how should we correct the formula? Okay, anyone, please? All right, Nancy. So Nancy suggests that we $4. Okay, $4. Let's see what happens if we. Okay, Nancy, why did you recommend that? That it be $4 also makes sin also. Nancy, why are you recommending to make it $4?
So that the 4 is locked and the C could be moved to the letter D.
Yes, that's correct. No, so that we're locking row 4. We don't want we don't want the denominator to move out of row 4, but we want the columns to move. Okay, so that we don't fix the column and rather just fix the row. Okay, so if we do this, all right, copying down will give us the correct result. Okay, it will still be under C4. And then when we move this to the right, okay, you now see that it's divided by it. The sales for 2020 is now expressed as a percentage. Okay, we copied it to the right and then copy it down there. Okay, so if we check 2020, it will be the cost of goods sold of 2020 divided by the sales of 2020. If we go to 2019, it will be the cost of goods sold of 2019 divided by the sales of 2019. If we go down here, okay, we're checking, okay, it's correct, divided by the sales of 2020. And for this one, okay, it's correct, okay, divided by the sales of 2019. Okay, so this is the correct way to do your vertical analysis or common size statement. So that's for the income statement. Now for the balance sheet, okay, before we go to the balance sheet, it's also best to copy the formatting because this is just like an income statement. So let's maintain the borders. So double border here, top and where's top and bottom border there, and then also here, also top and bottom borders, and then here should be double border there. Okay, so it now looks like a balance sheet income statement, only that the difference is that this is expressed in a common size form, which means common size, everything expressed in terms of one particular account in a particular year. So for all the years 2021, 2020, and 2019, everything is always expressed in terms of sales as far as the income statement is concerned. Okay, so let's quickly take a look at this, what this means. So for instance, in 2021, cost of goods sold accounted for 82% of the sales. So which means if you sold 100 pesos of goods, 82% of that is a cost of goods. Okay, and then around 8.7% is coming from other expenses. 1.7 to 1% is depreciation. So if you add the total operating costs for every 100 pesos of sales, around 92 pesos, 92.86 centavos is total operating costs. So that gives us with only 7 pesos and 14 centavos of operating profit for every 100 pesos of sales. Okay, and then the interest expense is for every 100 peso of sales, it's 1 peso and 14 centavos, giving us a before tax profit of 6 pesos and 1 centavo. Okay, the tax is 2 peso 40 centavos for every peso of sales. Therefore, the net income is 3.6% or 3 pesos 60 centavos for every sales of 100. Okay, and that's the same way you interpret for the 2020. In 2020, you can see here that the before tax profit is negative. Which means that for every 100 pesos of sales, the company has been losing already 2 pesos and 72 centavos. Okay, for 2020. It was in this case, it was a bad year for 2020. The company's net income was a loss, actually. It was a loss. So for every 100 peso of sales in 2020, the company was losing 1 peso and 63 centavos. As compared to 2019, they were earning 2.56, and 2021, they were earning 3.6. Okay, so this is how you do a common size statement, a vertical analysis for the income statement. Now for the balance sheet, okay, when we prepare the common size statement, everything is pegged with the total assets, okay, or since the total liabilities and equity is equal to the total assets, you can also use this. Okay, so let's do one formula. You know what to do with this. This is equal to the specific balance sheet account divided by the total assets, and we fix the row. Okay, Control Enter, and then we copy to the right, and then copy down, and we also do the same thing for the equity side, liability side. So you can divide this one divided by, you can use this one, the total liabilities and equity, or you can also use this one, the total assets, since they're the same. And then F4, just fix the row. Okay, copy to the right, copy down, and then let me just format it first. It can be format also. Double. Okay, so I hope you're able to do the common size statement for the balance sheet. If you're done, kindly please chat so that I know if I may continue already. If you're done with everything, including the formatting, okay, so you have here a balance sheet. Okay, thank you. Okay, let's wait for the others. Okay, very good. Thank you for your responses. Okay, thank you for your feedback. Let's wait for the others to finish their common size statement for the balance sheet. Okay, a few more seconds. Guys, hold on. Okay. All right. Sorry about that, class. Okay, so I guess everybody is already done with that. Okay, so let's take a look at our common size statement. Okay, we have looked at the common size statement for the income statement. We said that the common size statement for the income statement expresses everything in terms of sales. So when we read this, it's we're able to see the proportion of the different accounts versus sales. Okay, we can see if how much of the which account has the highest in relation to sales. So as I mentioned a while ago here, you can see that the total operating costs account for around 93% in 2021. Okay, in 2020, this was really problematic for the company because operating cost was at 99.7%, leaving only 0.3 for the operating profit. Okay, so what are we doing here? When we analyze financial statements, we do not say that if the company is performing well or good just based on one information. We have to look at it from a holistic perspective. That's why when we analyze financial statements and assess whether the company is performing well, we benchmark it against two things. Number one, we benchmark against direct competitors. Okay. Number two, we benchmark against time. Okay. So let me give you an example. For example, let's suppose company A, okay, versus company B. So company A had sales of, let's say, 5 million. Okay. And company B had sales of, let's say, 10 million. So we might be tempted to think that company B is the better performer because it had sales of double that of company B, company A, I mean. So just by looking at this figure, for example, this is sales, we can say that company B had more sales than company A. But we cannot say that company B performed better than company A. Okay, what do I mean by that? Let me explain. Okay, so when we analyze whether the company performed good or bad, we have to compare it with the direct competitors. Okay, so here we're comparing A and B, and we're saying that company A had more sales. However, okay, we cannot say that company B performed better. Okay, because let's suppose that the total assets of company A had total assets of 1 million. While company B had assets of 20 million. Okay, so this is maybe an exaggerated example, but this is an example which I'd like to highlight because many might make the mistake of saying company B performed better than company A because it had sales of 10 million vis-a-vis company A that only had 5 million. We have to, definitely we can say that company B had more sales. But as to whether company B performed better, that's another thing. Okay, because we have to look at it holistically. Okay. If, for example, company A had an asset of only 1 million, which means that they were generating, okay, for every peso of asset, they were, if I'm going to divide this, and this is a ratio, okay, for every 1 peso of asset used by the company, they were generating sales of 5. Okay, on the other hand, for company B, for every 1 peso of asset, they were only generating 50 centavos of sales. Okay, so you can see here the discrepancy. So if we're asking who the better performer is, based on the use of asset, based on the efficient use of asset, then company A is a better performer, a much better performer than company B. Okay. So when we analyze financial statements, one of the objectives is to determine whether the company is performing well or it's able to utilize its assets properly. We don't just take a look at one factor, one ratio, or one measure. It's a wrong thing to do. We have to look at it holistically and take a look at other factors, okay, and other ratios that will allow us to see whether the company is doing good or not. So aside from comparing against direct competitors, we should also compare with respect to time. So over the years, how has the company performed? Okay, how's the company performed? And that brings us now to the horizontal analysis. Okay, so for the horizontal analysis, what we're doing is we're computing the year-on-year progression, the growth rate. Okay, by how much did a particular account grow? Okay, over the past period, for example. So what's the formula for this one? The formula will be the current value. If we're comparing 2019 and 2020, then the current value will be 2020. So 2020 divided by the previous year, which is 2019 minus 1. This will give us the rate of growth, the growth rate. Okay, so 70% here means that sales increased by 70% from 2019 to 2020. And if you take a look at sales, from 3.4 million, it became 5.8 million. So, okay, that's the what this means. Sales grew by 70%. So we can copy this to the right, to the left, okay, and check the formula. So it's C4 divided by D4. The current value, because comparing 2021 and 2020, the current value is 2021, divided by the previous value, which is 2020, and then minus 1. Okay? And then we can copy this down. Okay, I'll give you a few seconds to do that. Okay, everyone got this? And then, of course, let's format this so that it follows a. It's easier to read if it looks like a financial income statement also. There. And that's should be right aligned because numbers are always right aligned. All right, so do the same for the balance sheet. It's the same formula actually. We can just copy this. Control C, Control V. So let's check. This one is cash. So current divided by previous minus 1. So we'll get a negative answer because cash balance went down. Okay, and then copy down. And then once again, format this. And then here also. So let me start with this one. It's already here. right there. Okay, so let me pause again to allow you to follow and kindly chat once more, class, if you're done with the horizontal analysis for the balance sheet also. Let's wait for the others to complete their horizontal analysis, horizontal the growth rate. Okay, about the rest, a few more seconds. Only 11 have responded so far. You are 22 in class. Okay, thank you for those who responded. How about the others? Okay, just a few more seconds for them to catch up in case they're still not done. Okay, thank you. All right, so thank you so much. Let's proceed. Okay, let's take a look once more at the common size statement. And let's try to see what we can learn from this common size statement. We already discussed the income statement. Let's take a look at the balance sheet. So for the common size statement for the balance sheet, it will tell us the proportion of the investments in terms of assets is concerned. In this case, we can see that the company is heavily invested in inventories, okay, accounting for almost 50% of the assets. Okay, and this can tell us a lot of things. It can tell us that the company is, if we're going to compare this, let's suppose that in the industry where the company is in, the inventory, the percentage of the inventory to total assets is, let's say, around 50%. Okay, so we can say that with respect to the industry average, the company has a lower proportion of inventory investment in its assets. And then the fixed assets is around 24%. Okay, the receivables is 25%. So we have to know the details about this, okay, in order to analyze more. Of course, when a company does this, they should know. They know usually the details so that they can come up with a more, let's say, more intelligent or assessment. All we can say here is that if we do also the common size statement with the horizontal analysis, we can say here that the company's inventories increased in 2019 to 2020 by 80%, and then by 33% in the following period, 2021 to 2020. Okay, and that the proportion of the inventory seemed to be fairly constant, except for 2020, where it dropped to around 44%, as compared to 48% in 2021 and 2019. Okay, for fixed assets, you notice that there was a jump as far as 2020 is concerned. In 2020, the percentage of fixed asset was at around 33%. But in 2019 and 2021, it was more or less around 24%. So there was a jump in 2020. Okay. And we can see here, for example, that fixed assets went down from 939 to 836. It was a decline of 11%. So the question is, what could be the reason for that? Did the company sell off or dispose some of its assets? Because comparing 2019 and 2020, assets ballooned by almost 3 times, no? Almost 3 times, because 1 point are twice, okay, more than twice, because 1.172 plus 1, that's 272. So that's almost 2.7 times increase in terms of fixed assets. Okay, so in terms of financing, we can see here that the except for 20, you can see here that current liabilities went up to 46% in 2020. Okay, and this was because of the increase in current liabilities from 481 to 1328 in 2020. Okay, also long-term debt, there was a 209.18% increase from 2019 to 2020. Take a look at your long-term debt here. 323 became 1 million, and then it went down to 500. That's why there was a decrease of 50%. So you can see here that the movement of the accounts in terms of comparing it with the total liabilities or equity, and in terms of its movement across time. Okay, so when you analyze financial statements, when we look at it, we can use this common size statement, the vertical analysis, and also the horizontal analysis. And if we have also the financial statements of our direct competitors, then we can compare and see who is if our company is performing as well as our direct competitor. Of course, when I say direct competitor, we should benchmark up. Okay, so a good example could be to compare Jollibee with Burger Machine. Of course, that's a bad comparison because Burger Machine is not a direct competitor. Okay, perhaps the direct competitor of Jollibee is McDonald's. Okay, so it would be best to compare to our direct competitor, and also compare with respect to time. Okay, any questions on this so far? May I have your chat, please, your feedback, if the explanation so far is clear. Okay, good. Good. Thank you. All right, let's go next to the computation of our NOWC, TOC. I'll give you around 5 minutes to complete this. Class, you know how to compute this already as a practice. I'll give you 5 minutes to complete this. I'll pause recording first so that the recording does not take a long pause. Okay, so take a look, please. I hope we have the same answers. These are the values that I'm getting. Okay, and I placed here the formula. There are any questions, please feel free to chat or to unmute yourselves. And if you're done, class, I would appreciate it if you chat, please, so that I know if I may continue. Okay, how about TOC? Let's go through this line by line. How about total operating capital, which is just the sum of your NOWC and net property, plant, and equipment. So this, you just added C23 is your net fixed assets. Okay, were you able to get that? The TOC? Kindly chat, please, again. If you were able to get TOC, let's go through this line by line. Okay, so how about the others, please? Okay, now let's go to the net investment. So this is very easy. Okay, you just subtract the current from the previous, and we have two values because we don't have the value for 2018. Okay, once again, class, kindly chat, please, if you were able to get the net investment in total operating capital. So for 2021, 447,000 was invested. For 2020, it was 1.11 million, 1.12 million. Were you able to get this? Okay, good. Thank you. A few more seconds. We haven't even completed, I haven't even gotten more than 50% response from the class. So let me give a few more seconds. Okay, I hope the others are able to follow. Okay, thank you. All right, so let's go to the next one. Okay, how about the NOPAT, net operating profit after tax? We know that the formula for NOPAT is your EBIT, okay, EBIT times 1 minus tax rate, right? So our EBIT is this one times 1 minus tax. Our tax is given at 40% here. Okay, so I'm going to fix the column so that I can copy the formula to the right. Okay, so you have here our NOPAT of these figures. Okay, once again, let me check if you were able to get the NOPAT. Kindly chat, please. Okay, thank you. Let's give a few more seconds for the others to respond to that question. Were you able to compute for the net operating profit after tax, which is very important in determining whether the company was able to create value for the shareholders in terms of either ROIC or EVA. Okay, so the responses are unfortunately getting fewer and fewer. Do you have any questions, guys? Because I see that more than 10 are not able to respond. Either they're not here. Hello, class. Any questions? Okay, so next we have the free cash flow. Okay, so for the free cash flow, we just subtract the NOPAT from the net investment in total operating capital. Okay. Feedback about the free cash flow? And you notice it's negative. So we said that we cannot say that if a free cash flow is negative, we cannot say that it's a bad performance. We have to dig deeper and see what really happened. In this case, it was negative. For 2020, it was negative because of a low NOPAT. Okay, we can say that this performance in 2020 was not good, it was bad because in the first place, then operating profit was very low. In fact, it went down compared to 2019. Okay, the company was able to recover, however, in 2019, 2021, I mean. All right. So that's the free cash flow. And then very important, the ROIC, the return on invested capital, which tells us if the company was able to create value for the shareholders. And how do we compute for the ROIC? Simply, it's the NOPAT divided by the beginning total operating capital. So we're using the beginning value here. Okay. 13.36. In 2020 was 0.92. Okay, so it's the NOPAT divided by the beginning capital, TOC. And since the weighted average cost of capital is 8% for both years, okay, we can say that value was destroyed for 2020. However, value was created in 2021 because the ROIC was greater than the weighted average cost of capital. And that can be seen also through the EVA. If the EVA is positive, then we say that value was created. If it's negative, then value was destroyed. Okay, so what formula did we use for the EVA? Okay, we have the NOPAT and then subtract whatever was the beginning capital, multiply the beginning capital with the average cost of capital. This is your capital charge. Okay. So, oops, wait. Sorry. Okay, the capital charge was 1080610. Okay, this was the penalty, or this was the cost of using the capital, but the NOPAT was 301, so it's good because the NOPAT was greater than the charge on capital. Okay, so we have here a positive EVA as compared to a negative EVA here. Okay, the NOPAT was very low. Okay, and then you have a beginning capital that's high, 1.14 million. Multiply that by the weighted average cost of capital. So the charge on capital, the charge on capital was 91,088. Okay, 91,088, and the NOPAT was 10,464. So the NOPAT was lower than the charge on the capital. That's why we're getting for 2020, we're getting a negative EVA, which means value was destroyed, which compares with your ROIC. ROIC is 0.92, it's less than 8%, so value was destroyed. Okay, for MVA, we're just comparing the market value. The market value is, the stock is sharing at 12.17. Multiply that by 250 shares of stock. So that's our market value. And then subtract the book value. The book value is here, total equity. Okay, so as of 2021, the market value added was 1065. For 2020, it was only 42,368. So the company was able to add more to its market value added in 2021. Okay. All right. So once again, guys, question. Were you able to get EVA? Kindly chat, please. Were you able to get the economic value added? So a few more seconds. I hope we reach more than 50% response rate from you. Okay, so last question, class. How about MVA? Were you able to get market value added? Feel free to ask questions if you need to have some clarifications about that formula. Okay. I'm looking at your chats and I'm not seeing any questions. I think we were able to get it. Good class. So this is a quick review of what we have discussed so far, and remember what the implications of these figures are. Okay, so I leave you guys to do the statement of cash flows for 2021. You know what to do with that already. Okay, so let's go now to the ratios. So we have, let's see, we have 5 different types of ratios here. L stands for liquidity ratios. AM stands for asset management. DR stands for debt ratio. PR stands for profitability ratios. And the market value ratios. Okay, so I already placed here the formula so that we save on time. Okay, I gave the formula here. All right, so let's first take a look at current ratio or liquidity ratios. What do liquidity ratios measure? We have two measure here, current ratio and quick ratio. So what do these ratios tell us? What information can we glean about liquidity ratios? Anyone, please? Okay, no guess? All right, current liquidity ratios are ratios that tell us of the capability of the firm to pay its current obligations as they fall due. So it tells us how capable the firm is in paying its current obligations as they fall due. Okay, so is the firm capable of paying off its current obligations? So we have two types here, current ratio and quick ratio. Okay, and the formula is your current assets divided by your current liabilities. So let's compute for this. Our current assets is, okay, here, current assets total, and then we divided by the total current liabilities, this one. Okay, so the answer is 2.58. Okay, so we're just dividing our current assets by current liabilities, and then we can copy this to the right. Okay, so for example, in 2021, could we say that the firm is capable of paying off its current obligations? Okay, by the way, notice I said current obligations. So these are the short-term obligations. These are different from the long-term obligations. When we look at the long-term, we're not measuring liquidity, but rather solvency. So solvency is the capability of the firm to pay off its long-term obligations. And so solvency, and we call it solvency. On the other hand, for short-term obligations, we call it liquidity. So current ratio is an example of a liquidity ratio. So for example, in 2021, was the firm able to Is a firm able to pay off its current obligations? Based on the number, yes. Because for every 1 peso of current liability, the company has 2.58 pesos of current assets, okay, to pay off its obligations, current obligations. Okay. In 2019, it was 2.33. However, in 2020, it was only 1.46. So it went down in 2020. However, it recovered, was able to increase its current ratio in 2021. Now, note just a caveat here. Okay, 2.58, okay, just tells us that the company has 2 pesos and 58 centavos for every peso of current obligation, current debt. However, we have to dig deeper. We just can't say that the company is okay. Okay. Number one, we have to benchmark it against time. Take a look at what's happening. 2020 seemed to be a very bad year for the company. And then we have to also benchmark it against a direct competitor. The direct competitor has a current ratio of 2.7, which means that just comparing the number, it has a greater capability to pay its current obligations. Okay, so that's based on the direct competitor. However, again, we can't stop there. We need to look deeper, okay, and look at the quality of the assets. Okay, so let me explain that further. So our assets are cash, short-term investments, receivables, inventories. There are no prepayments. Now, what if the company, just to exaggerate the example, let's suppose this is Boeing or Airbus. These are the two companies that produce aircrafts. Okay, and then just to highlight the explanation, the inventories of Boeing and the Airbus takes a long time to convert into finished goods, at least the work in process. Okay, and also the receivables, of course, might take longer. So if you can see here that the inventories make up 48.41% of the total assets. Okay, so but if we take a look at the current assets, okay, because it's part of the total assets, then for current assets, let's just divide this. Let's just see. Inventories divided by the total current assets. So inventories make up around 64% of the current assets. It's quite big. It's quite big. So we can say that that if the inventories are quite, if the inventories take a long time to convert into finish, take a long time to be converted into finished goods, then that might be a problem for the company. So what I'm saying is that we just don't base it on one figure, as I've been saying. You have to take a closer look at the nature or the quality of the asset of the accounts that are being considered. Okay, it's already time. May I just have this last one? For the current quick ratio, it's more strict because we don't use the total assets, total current assets. We just use cash and short-term investments, and then divided by the current liabilities. Okay, so we're just using these two most liquid assets. All right, and based on the quick ratio, we see that the company is even worse. Okay, because it has only, if the inventories and receivables cannot be converted into cash, then it will only have 8 centavos for every 1 peso of current obligation, current liability. So this is very low compared to the direct competitor, which has a 1-on-1. 1 peso of current quick asset, which is cash and marketable securities or short-term investments, for every 1 peso of current liability. So they're matched. But the company also has only 8 centavos of quick ratio. Okay, 8 centavos to pay a 1 peso current obligation. So this might be a problem for the company. All right. So as I said, guys, let me stop recording now. It's already time. Thank you for your patience.